The first part is Angie giving a setup on the process we went through with the SEC over the past 3 years. So without further ado, it is my pleasure to introduce Angela Dalton from Signum Growth Capital and Josh Klayman's from Linklaters law firm to discuss the process that the Web3 Foundation and the broader Polkadot ecosystem has found itself in over the past 3 years, working closely with US regulators to morph the DOT token from a security to software and what that means. Welcome, ladies.
Great. Thank you so much, Peter. Yeah, so I'll just go ahead and set the stage in terms of the last few years and what we've been doing. And we named this session "Less Truth, Less Trust, More Truth" on the Polkadot network, because that really is a mantra that has been driving us over the last 3 years, and this whole process of sticking to our ethos of true decentralization. And so, really, what I'll describe as the 3 year process with the SEC. This was both with the Office of FinHub and the SEC Division of Corporation Finance. This was not with enforcement, which is a totally different division who we never thankfully engaged with. So we had recently had a 3 year anniversary of this engagement with FinHub and Corporation Finance. And a few weeks ago, the Web3 Foundation announced in a blog that for the purposes of US federal securities laws, the native DOT token had morphed and was no longer a security. So I'll just give, maybe a one-liner on each of us. Daniel Schönberger, the Web3 Foundation's chief legal officer, joined from Google and has been working at the intersection of emerging technologies and all things law, ethics, society, public policy for more than 20 years. Joshua Klayman, as Peter said, head of blockchain digital assets at Linklaters. Josh and I have worked together for many, many years on many projects, and I can honestly say she brings the best legal analyses, especially in crypto, that I've seen in my career. And so I am the CEO and founder of Signum Growth Capital. We are a U.S. FINRA registered securities broker dealer in M&A, fundraising, and public markets. We've been the lead advisor to the Web3 Foundation since 2019. And, just before I start, I'm going to give the standard disclaimer on behalf of all three of us that nothing we say, or I guess on behalf of all of us, nothing we say is legal advice or investment advice. And the views that we are sharing are personal views. So just going back to 2014, and many of you on this call I can see will know this, but I want to go ahead and go over some basics just for people who don't. Polkadot was founded by a handful of creators of the Ethereum network. The founder of Polkadot, Dr. Gavin Wood, was previously co-founder of Ethereum and its CTO, as well as lead creator of the Ethereum virtual machine and Solidity coding language. So the Polkadot idea was really a base layer of software for other blockchains to be built on top of, not as a competitor to those blockchains. And some of the primary goals that we talk about a lot are really raising the bar on protecting end users, and doing this really by removing some of the cumbersome aspects of Web 2, like the need to trust the counterparties will deliver, and removing the cumbersome aspects of blockchain, like the requirement to pay high transaction fees for sometimes very basic activities. So I'll just say it up front because I'm sure somebody will bring it up. Polkadot is often criticized for its lack of marketing, especially of the DOT token. So this lack of marketing is by design. Polkadot is software built for engineers. It's not an investment mechanism for retail. It was not created to be a sort of alternative currency or method of payment. It was not built to be a smart contract network. It was built to be highly secure, vertical agnostic, use case agnostic, coordinating infrastructure, which really operates one layer below other networks, like Ethereum and Bitcoin. One of the analogies that we find resonates broadly is the New York City subway. So think about the underlying value that the New York City subway provides, which is completely detached from the value of the points of interest at those various stops along the way. So the New York City subway would be analogous to Polkadot, and these other layer one blockchains like Ethereum, Bitcoin, and the parachains, Polkadot parachains, which are built on top of Polkadot, would be more like these points of interest. So just taking us back to November of 2019. 6 months before the Polkadot network launch had started. Again, and then it was actually 25 months before the launch was completed in December of 2021. And going back to November of 2019, 3 years ago, the SEC had publicly invited digital asset related companies to, quote, come in and talk to us. And so, that's what we decided to do. The Polkadot team and its developers, really throughout the ecosystem, felt that the tech was so important to the world that they were willing to do whatever it took to be able to deliver Polkadot's native token DOT in compliance with U.S. federal securities laws, along with the laws of any regulator claiming jurisdiction, such as FINMA in Switzerland, the foundation's headquarters. So, again, back in this time, we were in the midst of, and this is, November, December 2019, early 2020, we were in the midst of the SEC halting the Telegram network and its native token from being even delivered to the original purchaser. So people had bought the Telegram native token in potentially a private transaction, and then they expected to receive that token when the network was delivered. The SEC halted that. And so we concluded, based on our analysis, that the SEC was likely to view the DOT token itself as a security, at least initially. But the interesting point was that the SEC had also published guidance concerning how a token that was initially sold as a security, potentially, under Reg D or Reg S, et cetera, an exemption, could morph and no longer be a security later. So even though it would be delivered to the initial purchasers as a security, it can then, after that point, morph. So, we really found that there was a lot of guidance on this point from the SEC, both in the frameworks and in their enforcement actions, such as Telegram and Kick. There have been 80 enforcements to date. And then the other big concept that we were thinking a lot about, sorry for my Discord noises in the background, was that it was important to deliver a network that wasn't decentralized in name only. And you hear that because people are referring to networks that might be using decentralized technology, but they're not decentralized in the way they operate and act, and the way information is handled. So in terms of Polkadot's technology, there are several ways in which true decentralization is just built in native to the tech. There was a recent independent study which ranked Polkadot at the very top of the industry on the Nakamoto coefficient. This is a key industry metric that's used to determine just how decentralized a blockchain network is. There was another recent study, we can post these in the chat, but there's another recent study that ranked Polkadot at the top of the industry on having the lowest carbon footprint within the industry. And again, Polkadot was very early to proof of stake. And this study analyzed Polkadot's version of proof of stake, which is called nominated proof of stake. And then just finally, as context on the size of the Polkadot developer community, it's the second largest globally behind Ethereum. And this was independently reported by Electric Capital, which has no connection to Web3. So we, went through a lot. Not we, the brilliant developers in Polkadot built a truly decentralized technology. I didn't even mention the validator system, which also has decentralization baked in, and equilibrium of the Polkadot network. The equilibrium point is a completely decentralized network on validation as well. But anyway, another extremely important part of decentralization is the softer things. And those are really hard. And they're very analogous to what a public company has to go through before it goes public and before it goes through the process of an IPO, for example, with the SEC. And that's looking at business processes, communications practices, disclosures to investments, to investors and to retail especially. And we didn't do agreements with exchanges in advance. We basically followed all of the laws that would apply to any publicly traded security. We also excluded certain VCs, and in doing that, the idea was to make sure that the amount of purchase, the amount of the size of the purchases were in line with consumptive use, not as purely speculation, for example. So anyway, I'm going to go to Daniel first of all and ask a question. And I think it would be good for you to give your background, Daniel, because you have worked. You joined the foundation from Google, and Google is really one of these entities that we look to as an example. The Web2 internet has really failed to meet basic human expectations of privacy and authenticity, and Google is really one of the culprits here. These Web2 entities rely on advertising as their sole way of making money, and as a side effect, we've seen online tracking, privacy breaches, etc. And so, love to hear why you joined Web3 as the chief legal officer, and what did you see in Polkadot?
Hi, everyone. So I finally made it. Apologies for holding this up. It's definitely the digital immigrant speaking here, but I finally figured out the setup. So that said, thanks for setting the stage, Angie. And to your question, well, when I joined Google in 2008, it was as the head of legal for Switzerland and Austria at their Zurich offices. Google was a very different company from what it is today. At the time, the Web 2.0 services really made a difference. Just think of the role YouTube and also other social media platforms played during the Arab Spring, for example. However, in the wake of the Snowden revelations, it dawned on me for the first time that the concentration of so much user data in one single place with one single entity might actually not be the very best form of data governance. And I still remember the email we all received from Larry the day after that story broke that came under the header, "What the f?" And that's what I really asked myself too. And obviously things only accelerated in the coming years. And at one point, I just thought to myself that there could also be better uses of my time and energy than defending the status quo of one of the most powerful companies on the planet. So the foundation's mission of delivering a decentralized and fair internet where users are actually put back in control of their own data, their identity and destiny, that resonated very well with me, and I signed up for it and joined the foundation a bit more than 7 months ago in May, that was.
Angie, I think you're muted and jump back in.
Oh, sorry, I just kept talking there. I was asking Daniel, what about the legal analysis that DOT is no longer a security really resonated the most with you?
Well, I just mentioned the foundation's vision of helping build a better internet, and I really take it from there, because when contemplating the launch of Polkadot, naturally, there was no intention to issue a security or engage in any form of DeFi. We really always thought of DOT as vertical agnostic, use case agnostic, coordinating software. Yet, as things were by the end of 2019, and you, Angie, gave a short rundown of that, we also understood that the SEC would likely view any token to be delivered after the initial fundraising as a security. But the legal framework also indicated that any given token could lose its characteristics as a security over time. And that's that process that is referred to as morphing. And this is what we wanted to achieve, move out of the realm of securities laws as quickly as possible, that is. So 3 years ago, we had our first meeting with the SEC, and this kicked off a series of meetings which continued over 3 years. And next to delivering truly decentralized tech, this also included setting up business processes to protect retail purchasers. And in essence, this meant communicating like a public company for us. Did we like all this or support the legal views of the SEC? Well, maybe not entirely. However, at the time, this was really our best approximation. Essentially, there were two choices. A, putting our efforts behind building what we deemed to be compliant with the law, or B, preparing for litigation. And we very clearly chose the former because we absolutely wanted to avoid a Telegram-like situation where Polkadot would be blocked. So we pulled through, and looking back, the process worked for us. That said, this process was iterative and flexible, and other projects might actually arrive at the same result slightly differently. But one of the reasons why we made our journey public here was certainly that we wanted to inform other players in the market about our experience. And today's session is obviously a part of this.
Definitely. Okay, let's turn to Josh. You have been in the crypto space for many, many years, as I mentioned. I first learned about you from your debate on crypto regulation with Marco Santori on Laura Shin's podcast back in 2017. You've never issued an opinion letter that concludes that token XYZ is not a security, really over the last 5 years since the ICO boom. So this is really a first for you. Can you frame the legal issues for us?
Thanks so much, Angie. And thank you guys all for listening in. Well, Angie, I think that you and Daniel have really set the scene well. And since you mentioned the Laura Shin podcast, I guess we can start the framing back in 2017. As you know, as Angie just reviewed, it was the ICO boom, right? It was an exciting time. And some of what I'm about to say probably will be a huge amount of review for some of you on the phone, and others, you may never have heard this before. So I'm going to try and, without going into too much specifics, give you a good background of some of the legal issues. So in July 2017, the SEC published its 21A report of investigation, the Dow. And we more commonly know that in our industry as the Dow report. So the Dow report did a lot of things. A few of the things it did was it made clear that token sales could be sales of investment contracts. And investment contracts are a type of security, for those who aren't aware. And that the Howey test, I can already imagine groans coming from the audience for those who've been hearing about this for several years. But I will review it just briefly. The Howey test asks whether there was an investment of money in a common enterprise with a reasonable expectation of profit based solely or primarily on the managerial or entrepreneurial efforts of others. And the Dow reports that that test was the applicable test for digital assets for being an investment contract. So basically, if you're selling a token for fundraising purposes to build out a blockchain network, you are highly likely, in the SEC's eyes, to be selling a security. And the Dow report also made clear that no matter where in the world you launch your token sale from, if you included U.S. purchasers, you need to comply with U.S. federal securities laws. In addition, the Dow report also indicated that the Dow token itself was a security. Now, the Dow report did a lot of other things, and I won't go into them right now. But if you put ourselves back in the situation back in 2017 after the Dow report came out, many market participants, including VCs, but many others as well, they wanted to be able to invest in digital assets without having that ultimate token that was delivered to initial purchasers, without having that token be deemed to be a security. And so a few months after the Dow report, a project called the SAFT white paper was released. And that introduced the concept of a SAFT. And it actually included, a form of SAFT on that white paper. And a SAFT, stands for, simple agreement for future tokens. And it was based on the form of a SAFE, a simple agreement for future equity, which was already, commonly accepted generally. And the theory was that the SAFT itself would be sold to investors explicitly as a security, right? You'd sell this SAFT, this document, pursuant to a valid exemption from registration, such as Regulation D or Regulation S, for fundraising purposes. And then the issuer, the token seller, in other words, would then build out a functional blockchain and deliver the token to the initial purchasers only once the token was functional for its intended purposes. And at that point, the hope was that the token that was delivered to initial purchasers at that time would not be deemed to be a security. I should say, I just want to pause for a second. There's a lot of talk in the space about how tokens need to be registered. You don't necessarily need to register a token in order to sell a token that may be a security legally, right? There are certain exemptions from registration. I've mentioned two of them, Reg D and Reg S, but there are others. There's Reg A plus. There's also some that apply to, employee compensation, things like that. So just bear that in mind as we go through this. Just going back to 2017, on that Laura Shin podcast that Angie mentioned, I had believed that by having investors explicitly invest in a future token, that it actually could, unfortunately, increase rather than decrease the likelihood that the resulting token would be viewed by the SEC to be a security at the time of delivery. Years later, we, as folks have talked about already, we have the Telegram case. And in my personal view, one of the key teachings from the Telegram case was that the SAFT doesn't work for its originally intended purpose. It works for a purpose, right? Which is to sell a digital asset that otherwise would be that is a security legally. It does help you, comply with exemptions, but it doesn't work for its originally intended purpose, that you could just deliver the token at the end of the day as though it were not a security, at least in the eyes of regulators, right? So delivery of a token, and this is what Telegram said in part, delivery of a token is not a separate transaction from the offer and sale. So you have to look back to the undertakings, the circumstances, and the understandings as of the time of the initial offer and sale to determine whether an investment contract and therefore a security exists. You don't get to reassess that at the time of token delivery. That's not a separate transaction. So if you sold a security, it's a security at the time of its delivery. What this also means is that if you sell a token pursuant to an exemption from registration, including pursuant to a SAFT, for example, you need to deliver that token to the same purchaser pursuant to the same available exemption. So, for example, if you were selling pursuant to Reg D, just for a moment, there are a number of requirements that you need to fulfill. For example, you need to make sure that the purchasers are not purchasing as underwriters, meaning that they're not purchasing with a view to immediately resell the tokens, right? This is important to bear in mind. And so I think of it as, you throw the ball up pursuant to an exemption, and then you need to catch the ball pursuant to that same exemption. And that includes, for example, making sure, as I just said, that the initial purchasers that you offered and sold to, that they're the same folks getting the token, that they still comply with, that they still, the same exemption is still available, and that they are not just purchasing with a view to immediate resale as one of the requirements. That is one of the differences between having a compliant security token sale and an illegal token sale. And I think that's another thing just to point out, is that a lot of people think that it's illegal to sell tokens that are securities without registering them. It is not illegal to do that. It is, as long as you have an available exemption, you do not need to register. Now, let me just say that's a very broad brushstroke. This is not legal advice, as Angie noted. And I think also, obviously, you have to look at the facts and circumstances for any token sale. So there could be reasons for which something would not be legal. But now I'm getting very lawyerly.
I think it's good. I think the way you just framed is good, just to boil down into kind of two periods. If I can simplify it, sorry for simplifying, but the period of like kind of before the network launches, where you've bought the security potentially under an exemption, and then when the token is delivered to you, so when in a lot of cases the network launches, that's one contract, and that token is delivered as a security, because it was purchased as a security. Now, once that token, which is a security, we're entering this kind of second period, is in the hands of the initial purchasers. And now we're in the period where we're going to hopefully see a network that decentralizes and a token that morphs away from being a security. What are the most important tools for analysis that have been provided by the SEC?
So one of the key tools, I would say, Angie, is the SEC's April 2019 Framework for Investment Contract Analysis of Digital Assets. It's available on the SEC website in the FinHub section, if I'm remembering correctly. And really, the framework, it has many factors, as I noted, and a criticism, I will say, of the SEC's framework is that many people say, well, initially, it looks like nearly every token sold will be deemed by the SEC or considered by the SEC to be a security, right? And people say, they criticize that. I would say, and I'm not a regulator, I would never speak for a regulator, but I would say if I were one, that's exactly right. That's exactly what the SEC has been saying all along. That's what Gary Gensler and before him, Chair Clayton, have been saying, that nearly every sale of a token for fundraising purposes is likely to be a security, at least at the outset, right? But as you and Daniel have both noted, there are factors within that SEC framework, 9 of them actually, although they're not all in one spot. And those 9 factors, they allow you to reassess when a digital asset that initially was sold as a security may no longer be deemed to be a security. And so once you've delivered the token pursuant to the initial exemption, you've kind of caught the ball, so to speak, and you've satisfied the delivery requirements, you can later reassess that token status against those 9 factors. And at a high level during our process with the SEC, that's really what we did.
Yeah, that that makes a lot of sense. So, during that 3-year period of meetings with the SEC, I've often felt like we're on a bit of an island doing things a little bit differently. And even people have said that to us in the last week or two, that we're going to have to explain this, more than once, which is fine. And I think we're all happy to do that and happy to talk to anybody here offline. But, at Brooklyn Law School about a week and a half ago, SEC Commissioner Jaime Lizarraga spoke so eloquently in the aftermath of FTX, and he spoke about gatekeepers. He specifically spoke about securities lawyers and their need to provide guidance, even if it's not the advice that their clients want to hear. And he pointed out that there are high levels of centralization in the digital assets ecosystem, and the idea that not all networks and projects and tech is centralized, but there's a lot of it. Can you discuss some of the steps that were taken to address these concerns of centralization?
Thanks so much, Angie. And I think just for those who are listening, it's important to remember when we talk about decentralization, we're really bringing it back to the Howey test, right? In a lot of ways, right? We're talking about the efforts of others. That's why, for example, the framework that was mentioned before talks about active persons and things like that. So as we think about why we would want to decentralize, just remember, think about the Howey test as well. And, some steps, since you asked specifically about some of the steps that were taken, some of them, they were part of the initial project design. So they, probably didn't have anything to do with lawyers or may not have. And those included things like on-chain governance and a fully on-chain treasury, right? But other steps, they came later and they required discipline and in many cases, some tough choices. For example, and some of this you've mentioned earlier in the call, but I do think it bears repeating, really making sure that DOT purchases were consistent with consumptive intent, both in terms of the size of the purchase and also by doing additional diligence, including sometimes actually speaking with purchasers to determine whether they intended to use DOT and what they intended to use it for. In some cases, as you noted, this involved turning down prospective purchasers who may have wished to purchase large amounts of DOT solely for investment purposes. But again, this also goes back to, qualifying for certain exemptions from registration in connection with the sale. Another important point really involved, it was another tough choice, or perhaps not tough in the case of this project, just because of the underlying ethos, and that involved limiting the relative percentages of DOT held by Web3 Foundation and its affiliates. One of the reasons for this is because governance, as I'm sure listeners know, is one of DOT's uses. Clearly not the only use, but it's one of DOT's uses. So it's important that, centralization not occur in that way, right? Next, really a key mantra has been for the project that tech gurus, they should talk about the tech, not market their tokens. And as you noted, that has sometimes resulted in Polkadot being criticized for lack of marketing. And as you noted, that was by design. And I think there also were other processes implemented, including about communications and reducing information asymmetries, Angie. And I think those are some things that you really put in place. And they included things like, batching communications about grants that were given to avoid moving the market if possible, having quiet periods, many things of that nature, and also disclosures, really trying to make sure that to the extent that the project may have material non-public information from time to time, that was disseminated to the public. And also, going along with that, in the event that certain information was held, there were instances where transactions were not engaged in by those holding those that information. So this goes back to what you were saying earlier, Angie and Daniel, about trying in many ways to think about how a public company might act in terms of communications and, again, reducing information asymmetries.
Yeah, it's when you say that I put in place, I would say shout out to the comms team at Web3 Foundation and Parity, because it is a training that has had to take place in terms of being able to sift through all the information that's out there and almost act like an investor relations team would act, with the idea that with the idea that the ultimate goal is really to protect retail who doesn't have all the information. So anyway, yeah, I just wanted to give a shout out to the comms team on that. And so Daniel, just want to switch to you on this. There's so many kind of narratives or common refrains in crypto. One of them is definitely the SEC is regulation by enforcement. Which, it has surprised me when people say that, because it isn't the SEC's role to create new laws. That would be on Congress, but it is the SEC's role to enforce the ones that we have in place. Can you just comment on that, whether you agree or disagree, and then also just anything else you took away from Commissioner Lizarraga's speech? And I'll give you last words before we turn it back over to Peter.
Sure thing. So, well, I would certainly agree that it is the SEC's core role to enforce the existing law. And to that end, Commissioner Lizarraga really made a very valid point in saying that it was not the SEC's responsibility to provide legal advice to projects, but that it would actually fall on those market participants and their legal counsels to apply the law and then make their own determinations. And to me, this makes a lot of sense. And as a matter of fact, this is exactly what we did with our announcement. And the speech of Commissioner Lizarraga is reconfirming that we did do the right thing. I need to admit, though, that in other markets, making such determinations was easier. Switzerland, for example, where the foundation is at home, issued a very clear law on distributed ledger technologies. Also there, we've been operating under no action letter from FINMA, the Swiss regulator, already since the end of last year. So there may still be room for improvement in the US, and I'm putting it as neutrally as I can, as I'm Swiss after all.
Love it. Peter, over to you.
Thank you very much, everyone. Wow, I'm in the settings for Twitter Spaces, and they have added so many interesting things since I was last here. That's clapping. There we go. Clapping. We're the soundboard now. Anyway, Emily, I sent one of the tweets over that links to the speech that Daniel just referenced. Commissioner Lizarraga from the SEC gave actually while sitting next to Josh at Brooklyn Law School a couple days after we put out that statement from the Web3 Foundation. So that's actually the first question. We have had some questions sent in advance of the spaces. Again, everyone, if you have questions for the panel, please put them in the question box in the bottom. But the first question is related to that statement that the Web3 Foundation put out a couple weeks ago now. Daniel, what were the intentions by going out with that statement proactively, and why at the moment we put it out?
Well, this was a very important and also newsworthy moment for us, obviously, and we lined it out here. We've been working very hard over 3 years with the SEC to actually get there where we are, to achieve that landmark stage in the project, which is the morphing from a security into a non-security and software. And we took the anniversary of our first engagement with the SEC 3 years ago to actually make that statement. And as I said before, it was also like a major intention here to inform others by that statement, but now also by talks like this one.
Yeah, it's understandable. It's a difficult sometimes to fully sort of pull out what a regulator is trying to say by not saying things, or sort of from an outsider's perspective, see through what they're saying, what they're doing. We still gonna continue to get the question and have gotten the question, like, why don't we have a no action letter to show everyone? Like, you sort of answered this, but to just be more explicit, this is the question on everyone's minds. Like, in crypto, broadly speaking, there's a couple of things in the regulatory world that everyone just sort of repeats, and this idea of a no action letter is like seared into everyone's minds. Maybe you can expand a little bit on why the things might be different going forward.
Sure. Well, obviously, I can't speak on behalf of the SEC, and we can't control their actions. We can just do that for our own actions. But we just, like, after going through that process, and these were 50 plus meetings with the SEC, with the FinHub staff, with corporate finance. Some of those meetings more formal, some others just relatively short phone calls. But after that process, we just arrived at a point where we were very comfortable that we actually did morph, that DOT lost its characteristics as a security. We also are confident that the SEC staff understood the nuances of the Polkadot network, understood what it is not, and understood that DOT is essentially coordinating software. And we also shared that view with the SEC. Now, that said, and I need to reiterate what Commissioner Lizarraga said, that it was not the SEC's responsibility to provide legal counsel. And as a lawyer trained in civil law, that resonates very well with me. Like, that's what lawyers are there for. You just apply the law, and then you make your determination. And that was really reinforced by the SEC, by that speech Commissioner Lizarraga gave, and it looks as if this is really as good as it gets at the moment. we're comfortable with this.
And may
Yeah.
I jump in for a second?
Go for it, Josh.
Sure. Thanks. So just as a bit of background, as was noted by Daniel and Angie earlier, we really were dealing with the Office of FinHub and also the Division of Corporation Finance. We were not dealing with enforcement. We were dealing with the folks who would write a no action letter. And I think, what might be helpful to think about is I've pulled up a copy, just as an illustrative copy, of the Turnkey Jet no action letter. And if you read the beginning, what you see is the way these no action letters often begin, which is, it says, based on the facts presented, the division, meaning the Division of Corporation Finance, right? The division will not recommend enforcement action to the commission, meaning the SEC, if, in reliance on your opinion as counsel that the tokens are not securities, TKJ offers and sells the tokens without registration under the Securities Act and the Exchange Act. And then they go through a few notes. But these no action letters, they're always based on an incoming letter. To my knowledge, I probably shouldn't say always for anything, but just in general, no action letters, they're based on opinions of counsel and the facts presented, and they're very narrowly tailored. So the process that we were going through, and in our ability to get comfortable and to share our views repeatedly with the SEC, it's not that there is some vastly different process that one would follow.
Yeah, this is actually great. It leads into the next question, which was directed more in your direction, Josh. And I'm also going to sort of add on one that just came in from the audience that is also related. So specifically, I know obviously you can't, maybe can't be very specific, but what has the SEC staff conveyed to you about the DOT tokens specifically? And then the add-on just came in from the audience. Is now that we've quote unquote morphed from a security, is it possible to be in a situation where you unmorph or you morph back into a security? And maybe you can also explain this in the context of like a no action letter still isn't like a get out of jail free card in the same way that maybe morphing is similarly you still need to uphold your promises and the status that you set out to achieve.
Sure. And again, I know it's very lawyerly of me to keep reaffirming that this is not legal advice and I'm not speaking on behalf of regulators. These are just my personal thoughts. So, it's not, I don't know that I can exactly say precisely what the SEC has conveyed or said directly, or rather members of its staff have said directly about DOT. Nevertheless, I can affirm that we are comfortable that DOT has morphed and that it should be treated not as a security. Rather, we've expressed our view repeatedly that DOT at this point is software. And I will say we have expressed this openly, and to my knowledge, no one has suggested to us or said that the legal analysis that we have presented is wrong or does not work. In terms of the second part of the question about whether a token could morph back, I do believe that both, I don't have it in front of me, but both Hinman's speech and the framework leave open the possibility that something initially, something that became a non-security later could become a security. Nevertheless, my personal view is that these things are not floating around in the proverbial ether. I don't think that's something that, if we imagine that the original investment contract has been satisfied, okay, right? You've delivered what you promised in your white paper in all material respects. You've followed these other processes. You've applied against the 9 factors. I don't think you just somehow accidentally and without realizing it become a security again. I think there would, in my view, although this, is just my personal musings, okay? I believe that there would need to be another investment contract created. And certainly, if you had something and it was not a security, if you tried to offer and sell it in a manner that you were selling it and under the Howey test, it satisfied the Howey test, I think there's the possibility that yes, you could have that same token become a security. But I don't think it's something where, it's just sitting in a pool of water and 1 minute it's a non-security and then oops, it became a security. Like I believe that just as you look at the initial offer and sale, you need to look at what's going on. And so that's one thing. And just to your point, Peter, and for whoever submitted the question, thank you. With the no action letter, and again, not a regulator, but when you look at the no action letter, there are certain, when you look at a no action letter, there are certain criteria, right, that are taken generally from the incoming letter of the lawyer. And it says, these are the particular things that we're focused on from the SEC's perspective, right? You have to adhere to those things. So if we look again at the turnkey Jets no action letter, one of the things it says is, in reaching this position, we particularly note that TKJ will not use any funds from token sales to develop the TKJ platform, network, or app, and each of these will be fully developed and operational at the time any tokens are sold. And then a whole bunch of other things. Tokens will be immediately usable, etc. You have to stick to those items. These letters are very narrowly tailored. And in fact, for those of us who are lawyers, you have to be very careful when even relying upon a no action letter, because you have to make sure that you can argue that you're fitting into the same fact pattern. But again, if a project receives a no action letter and then they go off and do something different or that's inconsistent with the requirements of that letter, in my view, they wouldn't still be able to rely on that letter. So I hope that's helpful.
Into that, Peter, is it okay if I just add something to what
Josh? Go for it. You're up next, so please fill in.
Okay, yeah, I was just going to say the other thing that I think there's a narrative in crypto that, let's run to another regulator like the CFTC. And I would say we went through the hard work to go through the process with the SEC, and we would be ready to comply with any new laws or any new regulator claiming jurisdiction, right? So that's, a given. Having said that, I think it's not talked about enough that commodities, certain commodities are also securities. And so before we go running to other regulators, we just wanted to say, okay, let's go through this process with the SEC, because we know that when the token was delivered, it was a security. We know there's a morphing process, and we morphed away from that. And now we believe it's software. So I just
tell me more, Angie. Tell me more about, what does software mean for users? This is another question, and I think sort of the overarching question I posed at the top. And we've talked about the process. I have a few questions for you to wrap up here at the end about things that projects in the Polkadot ecosystem and the broader Polkadot or crypto ecosystem can use to help sort of help them down the same path that we took. But yeah, what does the software mean for users? Like, how does that change how users should think about Polkadot or what they're using?
I mean, I think that a very simple headline there is usage versus speculation, and using the dot token to build. So, but decentralization, and it also means decentralization. And in all the forms we talked about, not only the tech decentralization, but control, information, lack of material, non-public information. One of the things that one of the main points of history that I think that we forgot to mention here, or isn't really important that we didn't mention here, is the July 2020 pseudo key, when the Web3 Foundation gave up control by releasing the pseudo key. That was the point at which the network could not be rolled back, and also that period, July, August 2020, was the time that the Web3 Foundation delivered every point that it had described in the white paper. And the network was built, and decentralization had been achieved insofar that the network was in the hands of dot holders. So I think that, and then of course there needed to be, all these other processes put in place around communications, disclosures, and the lack of kind of affiliate control, et cetera. But we, I think at that point, it's software. It's software to be used by the 550 or however many teams are building on Polkadot, and for the developers. And the software was built for developers so that we can build a very strong, secure base for the future of the internet, Web3, which is vertical agnostic, use case agnostic, coordinated infrastructure, so that all of the creative people can build really cool applications on top of it. That really was when it became software. Was the point at which it was a solid ground upon which to build. Now, of course, the builders need to think about these issues too for their own parachains, their own blockchains that they're building, and we're absolutely happy to speak one on one.
This is the next question for you. So, I mean, maybe we can sort of roll it into the next one. How can teams in the Polkadot ecosystem, what can they take away from us being in this process, from this conversation? Can their tokens morph too? You mentioned they're not automatically, quote unquote, safe under the umbrella of Polkadot. The foundation is sound, right? But can they then do the same, follow the same process and morph themselves? What tools do we have now as an ecosystem, and also broadly a crypto ecosystem to achieve this for other projects?
Sure. So I would say that the Polkadot as a base is a safe place, and that it is, at least we've gone through the process and we've developed a good understanding of the criteria that the various projects need, including the Polkadot network. And so at least, a builder can come knowing that this is a secure base. Having said that, what you mentioned is absolutely true. These same criteria need to be applied to other projects. So we have a list. Daniel put out a blog post which had many of the criteria in it. We should definitely in the future put together more of a bulleted list potentially, or something that could help projects. But in the meantime, happy to just meet with people to talk about not only the technical implementation being decentralized, but also the governance model, the business processes, management, et cetera. And, just try to help people kind of be on that path to pure total decentralization, not only tech decentralization, but getting to the point where their own blockchain is software.
And
yeah, I think, yep, go ahead, Josh.
Sorry, I just want to add a caveat, which is, again, very lawyerly. When Angie says safe, it's not a representation or something like that. What she means, I believe, is that we believe that we are not, and by we, I'm saying, I don't mean me personally, but when we, including me personally, believe that there will not be an enforcement action for violation of the securities laws in connection with the sale of DOT. That's what we mean. The idea is to provide some sort of peace of mind, right? Not saying necessarily that things are, quote, safe, because obviously risks abound everywhere, including in our space.
Yep.
Yes, but long story short, and I'm not a lawyer, so I'm able to do that. We are confident, and we are happy to help anyone who wants to learn more. Come and talk to us. We're going to be hosting a lot more conversations like this one. Thank you all for coming today. Please feel free to reach out to any of us in our DMs with additional questions. Ask them in the tweet follow up to this, and I'm happy to follow up with other specific questions asynchronously. But I think the key thing is here, as an ecosystem, accomplished something really extraordinary. The timing in crypto is always an interesting factor, but something that we can't control. But everyone who's a part of the Polkadot ecosystem should take confidence from this and keep building, because we do have our eyes focused on the long term. So thank you all for joining us today, and I'll hope to see you all soon. Bye-bye.